And 72% of the time the market goes up. And the answer came to me. And that's when I developed my chart. The answer came to me is because, just like Caterpillar, when they pull their money out, you get out. Whoa.
It's your daily dose of how to manage your money. And now it's time for Phil's Gang on the Off the Wall Street Network.
Oh, my God. Are you nuts?
With your host, Phil Grande.
Bye. And welcome to my podcast. Good afternoon. I'm Phil Grande. Okay, so a couple of things are going on here I want to talk about. First, we have, I'll play these cuts first to set this up for you. Now remember, we're being told the economy's doing terrific. Best economy ever, right? And we're being told how the consumer's powerful. Now, and the earnings are really good and solid. Go ahead and play those cuts.
What do you make of all these numbers? You do this every day.
It's you started off talking about a temperature check. I say sizzling. That's the temperature, sizzling.
Looking through this year, this has really been much more of an earnings-led market.
No, that's true. Now, let's check on the businesses. Have you heard, I'm sure you've heard if I have, as you're driving along, you got the radio on, everybody's talking about, hey, you can get a business loan overnight. Matter of fact, in 5 hours, we can give you $200,000, $300,000, no personal signatures. Well, those are private lenders, okay, and they compete with the banks. Well, we just got a report, okay, and what we're finding out is that the economy is not sizzling. How can it be sizzling? First of all, we have proof with Costco and Walmart. They're tanking. Target's tanking. How's that show the economy is sizzling and the consumer is strong? Just the opposite. But what's going on is now the percentage of companies, I'm talking about these private credit companies, they're in real trouble. You have these giant investment firms. Again, I'm sure you heard on the radio, they make loans to companies instead of going to the bank. And everybody's happy and they borrow money on the radio all day. But businesses can't pay their loans. In fact, the businesses that can't pay these loans back are at a record high. So how can the economy be sizzling? And people go to these lenders. They have no choice. Because even if you go to a bank and you have a good company, solid earnings in your private company, they won't loan you. Or if they loan you, I mean, it's like unbelievable. I mean, what you have to go through to get a loan, even if you have pristine credit and good books and everything's great. I mean, these banks are just terrible to do business with. They don't want to loan money. They want to make money on credit cards. But going back to what we started here, businesses cannot pay their loans back, these small businesses. And we're not talking about a small amount of businesses. And I mean, you're talking about a huge amount. Matter of fact, in April, the amount of businesses that have these loans, a historic amount of these loans have gone bad. Gone bad. Now, so you have more companies missing payments, and then when they refinance, I mean, it's a joke. It's just like a hope mode. I'm hoping something's going to improve. So these private credit default rates, as I said, they just hit an all-time high. People missing these loans. And the prescription, when they start missing loans, they rewrite it, extend it, and then go into the pretend mode. Now, over 100 separate defaults occurred in April alone. That's the highest ever recorded. So how can the economy be sizzling? This is crazy. So this is just ridiculous. So the next time you hear how the economy's doing good and earnings are doing well and all that, it's nothing but a bold-faced lie. That's all it is. Okay. Again, to say the economy's sizzling. I mean, look at the proof all over. Let's talk about the market. So the stock market today. Well, what do we know about the market today? Well, we saw that our 4 favorite stocks that have been holding up the entire S&P 500, which, by the way, out of this 7, there's 12 stocks. Only 4 are holding up the whole 700. Now, when I say 700, I'm talking about the S&P 500. I'm talking about the other, the S&P and the Nasdaq 100 and XLK, about 100. And so they're holding up all of these stocks. But what's happened today, there was a big pullback on these stocks. But it's nothing to get worried about because it was computerized selling. These institutions, the big institutions, okay, they have these big computer programs that kick in. And it's just a profit taking that's going on. That's all. So there's nothing to get worried about. So let's explain what these stocks are. Nobody ever explains what the hell these things are. And these 4 stocks, these machine stocks, they make the machines for the chips. These 4 are so powerful, have so much liquidity, so huge, that no one cares about earnings and no one cares about yields. Look what's happened. If you take the kill zone, starts at 4.50, right? The kill zone. We went to 4.75. And then at the same time, credit spreads collapsed to minus 77. Are you nuts? And the yield curve, which is the important one, inverted to minus 44. Now remember, that's got to be at a plus 150, so banks will make loans. And that's why small businesses are running to these private lenders, because banks won't make loans, because even though if you look at the not the yield curve, but if you look at the credit spreads, those are the ones that judge how if your bank's safe. It's not going to be another 2008. That's fine. We do know the banks are safe, but that's not the one we look at. The one we really look at is the yield curve. That's the ideal one. And you want it to be at plus 150, not minus 44. It means that we're inverted. That's very dangerous. And also, you got it to get to that 150 from minus 44. That's almost 200 point improvement, basis point improvement. How are you going to do that? You're not going to be able to. But anyways, the kill zone, everybody ignored it when we hit 4.75. Nobody cared. As I said, the credit spreads, 77 minus 77, nobody cared. Yield curve, inverted, minus 44. Going to need about 200 plus to get up to 150. What are you, nuts? QT is still running. They're still pulling money out. Deficits, the United States government, are still exploding. And that's why the United States government every day is begging people to loan to them with T-bills instead of long-term debt. They're in trouble. So, yeah, there's no crash. No crash. There's no fear. And so why is the market ignoring all of this? It makes no sense, does it? Not at all. Well, the problem now is for the market to correct, to be healthy again, we're going to have to hit, think about this, ASML, AMAT, LRCX, CLAC, which are the biggest stocks. Those 4 stocks are the parking lot for institutional money. Think about that. These are so big, these companies so liquid, institutions are not buying their stocks with the idea that they're going up. they're parking money in those stocks. And they can park 500 million, 300 million in a whack every day, and the stock hardly moves. And that's what they want. Now, to get a correction, because they're ignoring all this bad news, because everybody's so impressed with AI and the amount of money that's going into AI, they're looking at yields as the Stone Age. Why do you got to look at those anymore? Look how great 4 stocks out of 700 are doing. But remember, to hit 5% to get a correction is going to be really hard to do. I mean, you'd have to have oil above $110 to hit 5%. We were at 4.75. We couldn't hit that 5%. And even 4.50, 4.55, we should have had at least a correction of 10%. We didn't. Now, how are we going to get oil above 110? Foreign buyers, Japan, China, they have to stop buying our treasuries. That's not going to happen. Congress has to stall funding our debt and our deficits. That's not going to happen. Those are just some of the things that have to occur so that we get a 5% yield. So the market will correct, which we need, because you need corrections to make it healthy. And so right now, think of the AI 12 stocks. These 4 stocks come from these AI 12. Well, think about this. Nobody's talking about it. So the AI 12 stocks are more powerful than the Magnificent 7 stocks. Why? Because of the institution parking of money in the 4 machine makers, not the Magnificent 7. You can't park money in Magnificent 7. That's why these 4 stocks are carrying the whole market. They're so strong. So think of the Magnificent 7 as passengers, and the ripping 12, we'll call them, as the engine. Now, and also think of the Magnificent 7 as now a subset of A12, a subset of A12. A12 is this A12, but the 4 of A12 carry this whole market. These 4 stocks are the engine of the market, the supply chain. So what's going to happen? Well, again, to take down these stocks, we're going to have a deficit blowout. That's not going to happen. And so what is going to happen is this. Everyone's going to continue, like when these stocks came back today, you watch, these 5 stocks, everybody's going to jump in and buy on the dip. The 5 machine stocks, ASML, AMAT, LRCX, CLAC, they're going to buy those on the dip. You don't buy on the dip. You can't buy on a dip when there's no QE. See, we did all our big buying on a dip from 2008 to 2012 because we had QE. We had a guarantee. When we went and bought on dips, we were guaranteed by the Fed that they would push the stock price right back up, because that's what QE is a guarantee. When you print money, the Treasury gives it to the Fed goes and buy bonds and yields drop. That pushes these stocks up, especially tech stocks. That's why we had a 1,200% increase in the S&P and 600% increase in the NASDAQ 100. That's why, because there was a guarantee. Every time the stock market dipped, you buy. I'll guarantee you stock's going up. We don't have that right now. So if you buy in a dip, you got to be crazy. So what's going to happen is these yields, as they're pulling back right now, stocks, these tech stocks are going to keep going up. They're going to keep going up. But at some point, there's going to be a crack. And what you have to watch to make sure when that crack hits, you got to watch that yield curve. It's never been wrong. Never been wrong. And again, that yield curve, as yields start climbing again, it will tell you. Now, even though we had a yield climb from 4.25 to 4.75, and we didn't have as much as a 2% correction, that's very, very dangerous. That's very dangerous. So right now, the best thing to do is this. Stay with the winners. That's what we're doing. We're going to short the banks. We did beautifully on our swing trades on our bank stocks. They made us a lot of money. Now we're looking to short the bank stocks. We did a swing trade. Now we're looking to short them. Our tech stocks have gone through the moon. But you got to remember the one big thing, the one reason that everybody is so excited about AI is the amount of money that goes through AI. It's just amazing. There's $200 billion in those four stocks every day. Can you imagine? So stay with the winners. We'll help you here in Phil's Game, free for 10 days. Check us out.
Are you nuts?